at comparisons between service businesses and retail businesses. And I focused heavily on the income statement in that comparison and introduced you to some new accounts along the way. Cost of goods sold was one of them. Cost of goods sold is a new expense account that we have. We also talked about sales as a revenue account associated with selling merchandise inventory. We have merchandise inventory, which is a new asset account. So along the way, we grabbed a few additional accounts. No new categories or classifications, just some additional accounts. And the thing I think we left off with this one was taking a look at the purchase of inventory and then paying for that inventory within a discount period. So we talked about discounts. And we had this transaction which started off with the purchase of merchandise inventory. And again, I use T accounts a lot of the times, well, most of the time, I guess, to explain these concepts. So we're really adding some additional accounts to our already pretty lengthy list of existing accounts. We want to make sure we're keeping up with those. So I will probably review that list and debit and credit rules before the end of the week, because you guys are going on break next week, and I want to make sure that we're all on the same page. Okay. So then we had this transaction where Z-Mart paid the amount that they owed, but they were able to take a 2% discount because they paid within the discount period. So the issue is that we have this liability that we're satisfying by paying this bill. But my cash amount was less than my accounts payable. So we said we're going to clear out that accounts payable, right? The cash was $490 because we got to take a 2% discount, and 2% of $500 is $10. And so we said, well, what was this other $10? And we said we deducted from merchandise inventory, right? Because my merchandise inventory value has to be equal to the cash that I paid for that merchandise inventory. But at the same time, I'm satisfying the liability in full, so I want to be able to zero out my accounts payable. Okay, make sense? All right, so that's where we left off. And here's the T accounts for you here. Now, I didn't give you cash. I tend to ignore cash with these transactions. But okay, so let's talk about what happens. And this is just, things that happen in the normal course of business day to day for a retailer. People bring things back, right? So when we buy, so you're going to think about the cycle we talked about the other day. Before I can sell anything in my store, I got to buy it first, right? And I'm going to buy whatever it is that I'm selling from a vendor or a supplier. So when I get my shipments in, I examine those shipments. And I'm examining them for a number of reasons, right? I want to make sure that what I ordered is what I received, that what I received is in good condition, right? And sometimes those things don't happen the way that you plan them, so you have to send things back. Okay, so we have purchase returns, where we're going to actually return merchandise that we purchased. So some of this merchandise inventory you got to send back because it wasn't right or it was defective or something like that. Or something called a purchase allowance. Look, it might not be perfect what you ordered, but you're willing to keep it if the seller will take a little bit off the cost that you're paying. So those are two situations we need to talk about here. Now, the great thing about these two situations is we have no new accounts that we're dealing with. We already have the accounts that we need to address these two situations. So here's an example here. On November 5th, Z-Mart, the buyer, issues a $30 debit memo for an allowance from Trex for defective merchandise. Now, that's a lot of, jumbo that we really don't need to explain this, but anyway. So they're making an allowance for defective goods. Like, this company isn't going to send them back, but they want some money taken off the purchase price. And so notice what they're doing here. They're reducing the accounts payable by $30. And they're reducing the value of the inventory by $30. Now that's assuming there was a balance in the account prior. So if we make this assumption before we make a payment, okay, if this is what we assume happened before, just that purchase, we're saying some of this material that we received wasn't 100% what we were expecting, okay? So there's some of it's defective. So the company agreed to take $30 off the price for us. So that reduces this by 30, right? But it also reduces the value of my merchandise inventory by the same amount. And that's all that it does. I'm not going to pay for something that is defective. Does that make sense? I'm not going to pay for something that's defective. So I want my accounts payable to reflect what I owe. And I'm not going to pay for something that's defective. Okay, so we have a series of transactions here. Let's take a look because this will kind of set the stage here. It says Z-Mart purchases $250 of merchandise. And I'm going to use T accounts up here as we go so you can kind of see how this works, and then we're going to practice. So Z-Mart purchases $250 of merchandise on June 1st with terms of 210 net 60. Somebody tell me what that means, 210 net 60. Translate.
2% discount within the first 10 days of the 60 day period.
Okay, so you have you get a 2% discount if you pay within the first 10 days. If you don't pay within the first 10 days, the balance is due in 60 days. So that's a little bit of a longer credit period than what we're used to seeing, which is typically 30 days. But that's okay, they can do whatever they want, really. On June 3rd, Z-Mart returns $50 of goods before paying the invoice. And then Z-Mart pays the invoice on June 11th, and because it's exactly 10 days, they get to take the 2% discount. All right, so how does this all work? You see the transactions here. June 1st, purchase $250 of merchandise. So debit to merchandise inventory, a credit to accounts payable. So a debit to merchandise inventory and a credit to accounts payable. And again, I didn't label this one. This is a liability, right? Everybody should know that by now. You should know your debit and credit rules by now so that you know where to put your pluses and your minuses. I told you those weren't going away, right? We're using them all semester. And then on June 3rd, after a couple of days, you examine these items and decide that there's $50 of goods that need returned for whatever reason. They're defective or something like that. Okay. So on June 3rd, notice that they just do the reversal of what they did when they purchased them. So a debit to accounts payable, right? Sending something back. And a credit to merchandise inventory because we don't have that amount of inventory anymore. That takes the balance of both of these accounts down to $200, which is equal to the value of the inventory that I kept, right? And then on June 11th, you're going to take a discount on the remaining balance. Don't calculate a discount on $250. You don't owe $250, so you don't get a discount on $250. The discount is on the balance of $200. So if you get a 2% discount on $200, it's $4, right? So you're only going to be paying $196, but you want to clear out that account in full. So here's what happens. We debit accounts payable for $200. And that zeroes out that account, right? Notice there's a credit to merchandise inventory for the amount of the discount, which takes the balance of merchandise inventory down to, see the credit to cash there for $196, right? So a debit to accounts payable, a credit to merchandise inventory, a credit to cash. The merchandise, the discount is handled through the merchandise inventory account. And this has to be equal to the cash paid for the inventory. The value of your merchandise inventory must be equal to the cash paid for that inventory. You with me so far? All right, now let's talk, before we do some problems here, let's talk about transportation. So we all know that when we order things, they have to be shipped to us some way, right? And so we're all familiar with, shipping companies and shipping, how shipping actually works. But when you're talking about transportation costs in terms of these relationships between buyers and sellers, one has to take responsibility for paying the shipping, just like you and I do. Sometimes we pay shipping and sometimes the seller offers free shipping, right? And then when we get free shipping, we're just assuming that they're paying the shipping costs for us. Okay, so same kind of situation that you and I can run into. On the invoice that we looked at the other day, and I'm actually going to go back to that invoice because I want to show you where it is on here. Oh, it's way back here. Here we go. So on this invoice, I mentioned something that I said I would explain later. And underneath freight, it says FOB destination. So you need to know that FOB means free on board. The word destination is typically replaced by a city, the name of a city, okay? There's also another term, FOB. So FOB destination is the city to where the goods are supposed to be, are being sent. Let's put it that way. City to where goods are being sent. Okay. And then something called FOB shipping point. Okay. And that is the city from where the goods were shipped. Okay. And there'll be some sort of identification of those freight terms on that invoice somewhere. Now, what the heck do they mean, right? FOB shipping point. So this has to do with the title to the goods. When I say title, I'm talking about ownership. The shipping terms determine who owns the goods at a certain point. Just think about it. If I place an order online for something, okay, and it's in process, it's en route to me, I get the email that says your goods have been shipped. While they're on the truck, the airplane, whatever, coming to me, who owns those goods? And why do I care? Why do I care who owns them? Why do I care who owns them while they're on their way to me? If something happens to them en route. Do I have to, is it my responsibility to pay for those goods, or is it the seller's responsibility to take care of that, right? It depends. It actually depends on the shipping terms. Some shippers that you and I are accustomed to dealing with, UPS, FedEx, there's normally some kind of insurance built in, a minimum amount of insurance built in, so that if something happens to your item on the way, it's covered, right? That doesn't mean you don't pay for shipping. It just means that the shipper also includes some kind of insurance. But that's really important as far as the buyer-seller relationship goes, because who owns them determines then who replaces those items or goods if something happens to them along the way. So you need to be aware of that, okay? When your goods are shipped, FOB shipping point. In other words, let's say that we have something going from Loretto to Pittsburgh, okay? Obviously, Loretto would be the shipping point. And Pittsburgh is the destination, okay? If the goods are shipped FOB shipping point, that means that title or ownership of the goods passes to the buyer as soon as they're shipped. So they get on the truck in Loretto, they belong to the buyer already. So the buyer's responsible. The buyer's responsible. Now, there's probably some sort of insurance already for that, whatever it is they're buying, but it's the buyer's responsibility to make sure there's enough insurance, okay? So they belong to the buyer if they're, as soon as they're shipped, if the terms are FOB shipping point. So you'll see here, look, FOB shipping point, if those are the terms, then ownership transfers at the shipping point. No longer does the seller own those goods. They get placed on the truck, and now they are owned by the buyer. So in that case, the buyer is most likely going to pay for the shipping costs. Okay, so the buyer owns, the buyer pays the shipping. If the terms are FOB destination, in other words, while the goods are on the truck, they still belong to the seller. Ownership or title to the goods does not transfer until they reach their destination. So if it was FOB destination, then the buyer in Pittsburgh doesn't own those goods until they arrive at that buyer's location in Pittsburgh. In that case, the seller is responsible or is going to pay for the shipping costs. Okay? So if the seller pays for shipping, we don't worry too much about it. If the buyer pays for shipping, the buyer just adds the shipping costs directly to merchandise inventory. Just like we took a discount out of merchandise inventory, what you're going to see here is anytime we have an adjustment that affects the cost of our inventory, whether it be a discount, a return, or cost that we have to pay to get that inventory to us, it just gets added or subtracted to the merchandise inventory account. We do everything through that account. If you are the seller and you're paying to have these goods shipped to the buyer, then you may have a journal entry like this. You're not purchasing merchandise, you're selling it, right? So in that case, you have expenses associated with selling the items. Remember, there's a buyer and a seller. We're actually just looking at the transactions for the buyer right now, right? So we have to keep that in mind. When we're doing purchases, when we're recording purchases, we're the buyer. And this retail business, why are we buying inventory? What do we want to do with it? We want to sell it, right? So when we record sales transactions, we're the seller. See, those are two very different things, right? I'm dealing with vendors or suppliers here, but then my role changes over here, right? And as the seller, I'm dealing with customers or consumers. But if I open a store where I'm going to sell shoes, I can't sell any shoes till I buy them first. And I got to find a buyer, a manufacturer to actually purchase those shoes from, right? I have a relationship with that company or those companies, those individuals. And sometimes I have to send things back to them. But I'm the buyer in that case. When I turn around and I sell those shoes to my customers, I have a different set of transactions that I have to record. I have sales that I have to record. My relationship with them is I'm selling, there may be costs associated with me selling them. I might agree to ship their goods for nothing. Okay, so, excuse me, if you're the buyer, then you're debiting merchandise inventory to record freight or shipping. If you're the seller, you're probably going to be debiting something called delivery or transportation expense to do so. Okay, so that's actually a good slide there for that. So here's an example. It says Z-Mart purchased merchandise on terms of FOB shipping point. Z-Mart is the buyer. So if it's FOB shipping point, title transfers when the goods are shipped. Therefore, Z-Mart is the owner as soon as the goods are shipped, and Z-Mart has to pay the transportation costs. Notice Z-Mart is debiting merchandise inventory for $75. So if you're the buyer and you have to pay for shipping, you're going to debit merchandise inventory. I'm going to skip over that for now. All right, so I'm going to stop there because I want to make sure we understand all these purchase transactions before we turn around and do sales transactions. So remember, we've got to get inventory in our store, right? So that requires us to purchase items from a vendor or a supplier. Okay, so now we're going to do these on the board, even though we could do these. I just like doing them on the board because, well, writing them down is helpful when you're first learning. Okay, now what in the world did I want to do here? Okay, so I'm turning to page 205 of my textbook. You guys can look up here. Finally. Eventually unplugging it and plugging it back in isn't going to work. I don't know what's wrong with it, but for now it's fine. Okay, so we're going to take a look at exercise 4-3. And that's the only one we're going to do for now. So we're going to prepare journal entries to record the following transactions for a retail store. The retail store uses a perpetual inventory system, which I talked about. It just means that they're using computerized registers. And so those computerized registers keep an up-to-date balance of purchases, sales at all times. You always know how much inventory you have on hand. The gross method assumes that we're not going to record the discount unless we actually take it. That's what's meant by the gross method here. So that doesn't affect how we do anything. And we're going to be recording purchases, purchase returns, purchase allowances for these. So I'll start over here actually with this problem. And you guys are going to help me out, right? Okay, so exercise 4-3, and we're looking at April 2nd first. And I'm going to use T accounts too, and I suggest you use T accounts because, again, it helps with the debit and credit rules. Purchased $4,600 of merchandise from Lion Company. Okay, we're a retail store. They don't even give us the store name. That's okay. With credit terms of $215 net $60. So a 2% discount If we pay within 15 days, we get to take. Otherwise, the balance is due in 60 days. The invoice is dated April 2nd, so we'd have to pay by April 17th, right? And it says FOB shipping point. So FOB shipping point means that title to the goods transfers to us, we're the buyer, as soon as they're shipped, which means I own them and I'm responsible for paying the shipping. Okay? So they don't give us any of that information necessarily in April 2nd, but we'll get to that. So purchase $4,600 of merchandise. What do I debit and what do I credit? Just to record purchase of merchandise on account. What do I debit? What do I credit? Look at your PowerPoints. I'm not going, you guys are going to participate, or I'm going to give this as a graded assignment, and I'm not going to go through it with you. So what do I debit and what do I credit? Debit merchandise inventory. Credit accounts payable. And the amount is $4,600. That's the gross amount. We don't worry about the discount unless we actually end up taking the discount. So I got merchandise inventory over here. What kind of account is merchandise inventory? An asset, right? Accounts payable. Liability, and the normal balance is? Okay. So I have to have inventory in my inventory account before I can turn around and sell it to my customer. Hopefully that makes sense. All right, next one. Paid $300 cash for shipping charges on the April 2nd purchase. So it's April 3rd now, and I got the bill for shipping. I am responsible for paying the shipping because the terms were FOB shipping point. So what do I debit for my shipping costs? Merchandise inventory. Yay, somebody's paying attention. Okay, I debit merchandise inventory, and it said I paid cash. So this would be separate from the invoice that I received from Lion Company. The shipper is a different bill, right? But I still debit merchandise inventory, but I'm crediting cash. It says paid cash. Okay, so this will not affect my accounts payable because I'm not paying it to Lion Company. I'm paying the shipper. However, it was a cost that I had to incur to get the inventory to me. Therefore, I'm allowed to include it in the value of merchandise inventory. So far, so good? Questions? Anyone? All right, and then the next transaction, it says returned to Lion Company unacceptable merchandise that had an invoice price of $600. So something wasn't right, so we decided to return merchandise to Lion Company. Some of this $4,600 worth of merchandise wasn't any good, so we returned it. $600 to be exact. So what's my journal entry for returning? What do I debit and what do I credit?
You debit accounts payable, credit merchandise.
Okay, I'm going to do the reversal of what I did when I bought it. I'm going to debit accounts payable for $600, and I'm going to credit merchandise inventory. When I debit accounts payable, what does that do to the account? It reduces it, right? So look, this accounts payable is my invoice, really, right? It's the amount that I owe. Do I want to pay for something I returned? Well, I don't know about you, but I don't. I don't want to pay for something I returned. So I'm going to reduce the accounts payable, the account that represents the invoice that I have to pay. And because I sent back merchandise inventory, I don't have $600 of that inventory that I had originally, so I have to reduce that account as well. So that $600 gets credited to merchandise inventory. So it's the exact opposite of what I did when I bought it. Okay, now it's the 17th, and we're going to send a check to Lion Company for the April 2nd purchase, net of the discount, okay, and the returned merchandise. So it's the 17th. I owe $4,000, don't I? Right? Because I bought, original invoice was $4,600, I returned $600, so now the net amount I owe is $4,000. But is that the amount that I'm paying? No, it's not. Good, why not? Because I get to take a discount. I'm writing a check on the 17th. And my discount is 2%. It's 2% of what? 2% of 4,000. So let's figure that out before we do the journal entry. So 4,000 times 2%, I don't really even need a calculator here, is $80, right? Okay, so I get to pay $80 less than the 4,000. However, I am satisfying the liability in full. My liability is 4,000, so in order to reduce that account to zero, I have to debit accounts payable for 4,000. Okay, because that's going to zero that account out. However, my cash amount is going to be 4,000 minus $80, which is 3,920, right? Without a calculator, but I think I can handle that one. 3,920, right? Do my debits equal my credits? No, that's like a, what do you call that kind of sin that's really bad? I'm not Catholic. What do you guys call those? Catholic, we call those, I don't know. A what? A mortal sin, that's what I was talking about. It's like a mortal sin, right? Debits don't equal credits. Or cardinal sin, or mortal sin. I've heard these terms. I don't really know either, but anyway, it's bad, right? Our debits don't equal our credits. Our debits have to equal our credits, right? So what do I do? What do I credit this $80? Very good. Merchandise inventory. That's the discount, right? The discount has to be reflected through merchandise inventory. And if you want a calculation here, it's very simply just 4,000 times that 2%, right? So now when I add up my credits, they equal my debit. But when I post, notice over here, I'm going to post that $80 to the credit side. Now let's balance out that T account. Because I want to talk about the balance of merchandise inventory. Somebody tell me what the balance of merchandise inventory is. Okay. Now, 4,220, and I've been saying all along that this balance has to be equal to the cash that you paid for the inventory, right? So, 4,220 does not equal 3,920, does it? What am I missing? What's the difference between 4,220 and 3,920? The shipping. See, look, here's my cash, part of my cash, 3,920, but here's the other part of it. And when I take the 300 and I add to it what I paid for the inventory, so now the total value or total of what I paid for my merchandise inventory is still correct. The value of my merchandise inventory account must be equal to what I paid for that inventory. Invoice price ended up being $39.20. I paid for the shipping separately, but I still paid to get those goods to me, so I have to consider that and the invoice price in this case when I want to make sure that the balance of my merchandise inventory reflects what I paid for that inventory. You with me so far? All right, now, the transactions 18, 21, and 28. I'm going to give you 5 minutes here. You guys try those. We're making a new purchase now. All this is good. Now you can start a new merchandise inventory account, T account, and a new accounts payable T account, and I'll put those on the board on this side, but I want you to work on those for a few minutes. Got to know how to do these. These are on the test. And in this next exam, Connect is done in class, not outside of class. So the whole exam is taken in class, even though a portion of it is Connect. So there is no take-home part to this next test. You do the whole thing in class. You are going to be using Connect, and in that case, you're allowed to use your notes in your books, but you got to know how to do this pretty quickly, right? If you're doing it in class. So this is why we're practicing. So April 18th, purchased $8,500 of merchandise from Frist Corporation with credit terms of 110 net 30. Invoice dated April 18th, an FOB destination. Hopefully you know what that means. And then on the 21st, after negotiations, received from Frist a $500 allowance towards the amount owed. Something must have been wrong. You agreed to keep it, and they agreed to reduce the purchase price. And then you're going to pay for that purchase there at the end. So at least try it. If you don't know how to do it, that's okay. We're going to do it anyway, but at least make an effort. You should at least be able to do the transaction on the 18th. Follow the examples that are either in the PowerPoints or the examples we just did over here. There's similar transactions. All right, what about the transaction on the 18th? Purchased $8,500 of merchandise from Frist Corp with credit terms 110 net 30, invoice dated April 18th, FOB destination. What do I debit and what do I credit? Debit merchandise inventory, and what do I credit? Yep, accounts payable. That does not change. Anytime you purchase merchandise inventory, we debit merchandise inventory, we credit accounts payable. Okay. What about the terms, FOB destination? What does that mean? We don't pay for shipping because title to the goods does not transfer to us, the buyer, until they reach us, the destination. So in that case, the seller is going to be responsible for paying the shipping costs, and we're not journalizing the seller's transactions. We're only journalizing our own, so we do nothing with shipping. On the 21st, after some negotiations, they agree to give us a $500 allowance. So what do I do? In other words, I'm going to keep the inventory, but it's not worth as much as it was, and they're going to reduce my invoice by that much. So what do I debit and what do I credit? Debit accounts payable and credit merchandise inventory. Because if the inventory isn't as good as it should be, then it's not worth as much as I thought it was. So I have to reduce both the value and the invoice. I do not want to pay $8,500 for something that's not worth $8,500, right? And if the inventory isn't in 100% condition, then it's not worth what I paid either. So I have to reduce the value of it as well. It works the same as returning something, okay? And now on the 28th, I'm going to send a check to pay my bill. And it's 10 days, right, from the purchase date. So do I get to take a discount? I do. And what's the percentage of my discount? It's 1%, right? And what am I taking 1% of? The 8,000. So a 1% discount on 8,000 is $80, right? Okay, so what's my journal entry here? What am I getting rid of or satisfying by paying this? Not credit.
Oh, I knew that.
Yeah, I knew that's what you meant. Okay. Accounts payable debit for how much?
8,000.
Right, 8,000. Okay. What else?
We want to credit merchandise inventory to 80,
Okay, credit merchandise inventory for the discount, which is 80.
and then
Credit cash.
7,000.
Very good. 7,920. So that, again, my liability gets paid or satisfied in full. My discount gets adjusted through the merchandise inventory account, after which case my balance then goes down to 79.80. The value of my merchandise inventory is then equal to the amount of cash that I actually paid for that inventory. So far, so good? Questions?
Doesn't matter which one goes first.
No. Nope, doesn't matter. As long as you just get in the habit of listing debits before credits, that's really all I care about. As far as the order in which, if you have multiple debits or credits, doesn't matter which way you list them. Okay? Because they're all getting posted, as long as you don't forget to post anything. It's really not that, doesn't make a difference. All right, so anybody have questions on that before I move on? Okay, so now we have our merchandise inventory. Guess what we're going to do with that merchandise inventory? We're going to sell it, right? That's the whole point of buying it anyway. We're just not going to buy it, look at it, we want to sell it. So now we're going to take a look at sales transactions. So now you have to change your perspective, your point of view here. Your role is no longer buyer. You have your merchandise now. Okay? So I need you to understand that the purchasing has already taken place, and what you have now is you have a merchandise inventory account with value or balances already in it. This merchandise inventory is the inventory you're going to sell to your customers. So you've already done the purchasing. So the assumption that we make is there's already a balance in this account because we've already recorded the purchase transactions, right? So there's an amount in there. Now we're going to sell it. Anytime we sell inventory to a customer in a perpetual inventory system, there are 2 journal entries to record the sale. 2 journal entries to record the sale, and they're up there. The first one is to record the revenue received in the form of an asset from a customer, okay? And the second is to recognize your costs associated with that sale. So the first one is to recognize the revenue from the sale. And the second is to recognize your expense. So recognize the seller's expense. That seller's expense is called cost of goods sold. Because didn't I have to buy that inventory first before I could turn around and sell it to my customer? So I got to go back though, and we got to review something real quick here. Back in chapter 3, we learned about adjusting entries, right? Right? Okay. And we talked about certain assets that when they got used up, expired, lost their usefulness, they became what? Not liabilities, expenses, yeah. So assets eventually became expenses when they lost their benefit. And so some examples, we bought supplies, but then supplies got used up and they became what? Right? Supplies expense. Sound familiar? I hope. You guys just got done doing that, right? Chapter 3. And then we had prepaid insurance, which was an asset when we bought it, but then as that insurance policy expired, we had to transfer it to what account? Insurance expense. We had prepaid rent. And when that prepaid rent expired, what did it become? Rent expense. Okay. We also had plant assets like equipment and I don't know what that letter is. Equipment and buildings and automobiles. And we did those a little differently though, right? When they lost their usefulness or were worn out, what account did we use to express that? Depreciation expense. Okay, so loss of value, right? Or benefit, loss of a benefit, right? We said, okay, that's depreciation expense. So you're seeing the pattern here, I hope, right? Okay, don't we have a new inventory, a new asset account in this chapter? Merchandise inventory, right? That's our new asset, right? So if we're following suit here, when I buy merchandise inventory, it's an asset, I own it. I get a benefit. The benefit is that people come to my store and want to buy it. Okay? When I sell it, though, I lose the benefit because it's gone. Right? So it's sold. No more benefit because it's gone. I had to pay for that though first, didn't I? Okay? So if we're keeping in line here with what we've been doing, merchandise inventory was your new asset account. What was your new expense account you were introduced to in this chapter? Cost of goods sold. So it's the only expense account that doesn't have the word what in it? Right. It is an expense account. So when merchandise inventory gets sold, it gets transferred to cost of goods sold because it's no longer considered an asset because it's no longer providing me a benefit. I had to pay for it. So there's a cost associated with that. That's called an expense. So eventually, this is what is going to happen when I sell it. That's number 2. When I sell it to my customer, I'm going to move it from merchandise inventory to cost of goods sold. This first one, recognized revenue, you guys have done that transaction a dozen times, well, more than a dozen times. You've done it lots of times. All right, I'm going to stop there. This is where we'll pick up on Wednesday. We're going to finish this up on Wednesday. And unfortunately, we don't have time to have a test until after break. But I am going to give you guys some stuff to review so that this doesn't all sound foreign to you when you come back from fall break.